Okay. Other than Thanksgiving, we also talked about stocks and bonds. This is when the company issues their stocks and their bonds. We started talking about the two types. We said there are mainly two types of. If you remember, we said there are mainly basically two components of any stockholders' equity. Those two components are what? So those two components are what? Yes? Common stock and retained earnings. And we said this is when the company only has common stock. So basically, in order to have it like in a broader sense, we say that the company would have paid-in capital accounts and retained earnings, right? Under paid-in capital accounts, we studied how companies issue, how to account for issuing common stocks, preferred stocks. We also talked about paid-in capital in excess of par value and paid-in capital in excess of stated value, and then we learned how to make journal entries when the companies buy or sell treasury stocks, right? And we talked also about dividends. We talked about cash dividends. We said that preferred stocks, if they have cumulative rights, it means that they will have the right to get any dividends in arrears. Dividends in arrears are dividends that are outstanding from previous years. Those are from years where they did not get their yearly dividends, right? So in this case, preferred stocks would get all their dividends before common stocks touch a penny. This is it. So this was for cash dividends. We said that the other type of dividends that we will cover is stock dividends. Now the difference between the two, between stock dividends and cash dividends, other than one of them will be in cash, the other is in stock. Stock dividends, it depends in order to know how to account for it and how to enter it. It depends on the number of stocks that the company will issue. Remember, the company is issuing new stocks, which is to mean the company at this point is changing it might be basically the number of outstanding shares will change. Okay? So this will depend largely on the amount of stocks or the percentage of stocks that the company will issue. Why would companies issue stock dividends? Why would they declare and distribute stock dividends? This is if the company does not want to part with cash. They want to still satisfy their investors. They want to send a signal that they are not withholding dividends. They are not basically refraining from paying them dividends. However, maybe they want to increase. Basically, they can do that sometimes in order to make them happy, make their investors happy, without having to pay cash. Okay, maybe they want the cash. If you remember, for the board of directors to declare cash dividends, they will look at retained earnings and if the company has adequate cash. Okay, so in this case, what the company would be trying to do is to make sure that part of the company's retained earnings will be given or will be retained will be converted basically to investment. So it will remain permanently in the business. Because now they became stocks, right? Part of retained earnings now is stocks. Another reason why companies might issue common stock is when they might issue common stock as dividends is to increase the marketability of the stock. At a certain point, the stock price might get too high. So in order to make it more marketable and more accessible to more investors, what they do is they issue those stocks. They will increase the supply, which would automatically bring the price down. Okay? Okay, so now we're going to see how we're going to learn how to deal with stock dividends. Now, when the company issues stock, it could be a small stock dividend, and it could be a large stock dividend. So when it is between 20, something around 20, 25, or some below that amount, it is considered as insignificant. So it's not going to change or to have a huge effect on the stock in the market, right? So this is why companies, in this case, they will report it at fair value. So the company, when they issue that stock as cash dividend, they record it at fair value. And when, in this case, fair market value, it's a market value. So it's how much they actually, how much it is actually traded at this point. When it is a large common stock, the company will record it at par value. So this is at fair value. When it is greater than 25%, it becomes, it is usually recorded at par value. Okay? And again, the idea here is that it's from a materiality perspective. If like the company issues 10% stock dividend, it will be 10% of the outstanding shares. It's not expected to have a significant or material effect on the stock price compared to, for example, the large stock dividends. Remember, even stock dividends, they are distributed pro rata, which is to mean based on your share in the company. If you own 20% of the company, if you own 20% of the outstanding shares, you will also get 20% of the stock dividend. So it's the same thing as cash. The only difference is, in this case, it's basically that you will receive, instead of receiving that in cash, you receive additional shares. So Medline Corporation declares a 10% stock dividend. So is this a large or small stock dividend? A small stock dividend. As a result, it will be recorded at fair value. So at market value. On its 50,000 shares of $10 par value common stock. The current fair market value of the stock is $15. When the company issues stock, and here the company is declaring the stock. Remember, the company will declare the stock, they are declaring the dividend. So the company declares the dividend first, then they update their record a couple of weeks later to basically their user database. Once this is done, after they have updated their records, a couple of weeks later, they will actually, if it is cash, they would pay the dividend. If it is stocks, they will distribute those ones. So when the company declares dividends, in this case, it becomes automatically an obligation. Here, we debit stock dividends, fair value, market value, which is to mean it's 50,000 multiplied by $15. Because it is small, we ignore the par value. We only use the market value. So it's 50,000 multiplied by 10% because it is 10% stock. So 50,000 multiplied by 10% multiplied by the $15 stock value. Okay, so this is based on market value. And what do we credit? Did the company actually issue those stocks? Did they distribute them? So we credit common stock distributable. This is not a liability account. So common stock dividends distributable is an equity account, and you will see later on where it shows. Okay? Now, this is, again, it is common stock, so this will be at par value. Yes?
So, like the 50,000, is that because the company is issuing 50,000?
The company is issuing stocks. Whenever the company issues stocks, what do? You debit, you credit common stock at par value or at stated value. Because this one has, maybe I confuse you with this here, so I'm going to remove this one. So the par value will always be used when you record common stock. Okay? This is not when the company, this is when the companies are going to issue those stocks. The value of those stocks that will be distributed will be 50,000 according to the company's books. The difference between the two will be paid-in capital in excess of par value. So here it's as if the company is actually issuing stocks, so it's going to be the same thing. The difference is that it's not going, the company will not be distributing them now. Okay? So they will, this is the, however, if this happened before end of the year, the company will have to report that under the paid-in capital section. Do you understand the point here? This is not like dividends payable. This is different. In this case, this is common stocks that will be issued and will be distributed like a couple of weeks later. As a result, the company will include that under the paid-in capital. So the journal entry, when they actually issue those stocks, what do? The company will credit common stock at par value, so they will debit common stock dividend distributable. The combined effect of the two would be, it would be as if the company issued those stocks immediately. So if the company was going to actually issue those stocks and distribute them now, we would not have used common stock dividends distributable. So just to repeat that, when the company declares stock dividend, you debit. Stock dividend, you credit. Common stock dividends distributable. And then, if there is any difference between that amount and the par value, you credit paid-in capital in excess of par. When the company actually distributes and issue and distributes those stocks, we debit common stock dividend distributable and we credit common stock. Now the effect of issuing stock dividends on par value is zero. It does not affect par value. Later on, we will learn what happens when the company splits stock. With issuing stock dividends, the total stockholders' equity does not change. It's equal. You're simply taking part of retained earnings and putting that as paid-in capital. This is, if you remember when we said earlier that the company will permanently keep part of retained earnings in the business because now they issue those stocks. They turn them into paid-in capital. So before the dividend, retained earnings was 300,000. So this one decreased by 75,000. As you can see, paid-in capital increased by 75,000. Basically, you removed one part from retained earnings and you declared it as stock dividend, and you added it to the paid-in capital again. As a result, par value will not change. Total stockholders' equity will not change. What will change is the number of shares outstanding because you issued additional shares. Okay? So this one is going to change. This one has decreased. Par value is not going to change. You have to think about it from basically what happened. The company issued additional stocks, so the number of stocks increased. The company is not actually making any changes to the par value. what's happening is that the company is removing part of retained earnings and adding it to paid-in capital. So the total stockholders' equity will not change. Do you guys understand this point here? Okay. Bless you. Well, Lauren's sneeze actually saved you from what I was going to say. Guys? It is reported as what? I just said that. This distributable is added under paid-in capital. What you're doing, you're removing from retained earning, you're adding that under paid-in capital. So this is why you actually put it as additional, as an addition to capital stock. Okay? Because eventually this will become common stock. If you say, by the way, I understand the confusion about the reduction in retained earnings, but if you say reduction in retained earnings, that means retained earnings less. Are you going to use it as retained earnings less? This common stock dividend distributable, you're not going to use it as this. This is what we mean by reduction to retained earnings. We get to splitting common stock. So when the company splits common stock, it's done for different reasons. For example, when the price of the stock gets too high, not many investors will be willing to pay that much for one share. As a result, the company might want to split that stock, and by splitting the stock, par value itself will change. So the company is actually splitting par value as well. The number of stocks will, for example, if it is a 2-to-1 split, it means that the company splits those existing shares into two. So the total number of shares will double. In this case, par value will be half. Okay? Now, in many cases, like for example, in the case of Nike, what they did was they split, for example, the share by half. However, within a year, the price of the stock went back up. So the company now has more outstanding shares, and the stock price is still selling at a high price. So it was more or less like a win-win situation. Okay? In this case, as you can see, retained earnings, stockholders' equity, this will not change. What is changing is the number of outstanding shares and par value. When this happens, the company does not make any journal entries, by the way. This is something different. It's not like the company is not selling additional stocks. They are not buying additional stocks. They are simply splitting the stock into 2 or into 3 or into 4. Depends on how much they want to do that. Okay? In this case, your share as an investor, if you owned 20% of the company, after the stock split, you will still have or own 20% of the company. Your ownership will not change. So in this example here, the company has split 4-to-1, has split their stocks in a 4-to-1, and in this case, what happens that they said that you had 40 shares. You had, let's say, 40 shares. Now you have 80, right? Come on, guys. You had 40 shares. You split it by 4. Now you have 80. Yes. See, you are sleeping. You're thinking about the turkey. Give it some rest for like half an hour, and then you can go back to thinking about the turkey. Now I'm thinking about the turkey. Why did I say that? Okay. I'm hungry, so don't judge me. Because the turkey is gonna be tomorrow, not today. So if I'm not eating turkey today, no one is. Yes.
So you're gonna have a ratio
Sorry?
They have like a ratio of what the split is.
So the split is, for example, in this case, they split it 4-1. So every share was split into 4. They originally had, for example, let's say 100 shares. Now it's 400 shares. Let's say that the par value was $10 per share. Now you divide it by 4. The new par value becomes 2.5. Okay? So it's inversely proportional to the stock split. In this case, for example, if you had 10 shares, you end up with 40 shares. If you had 40 shares, you would end up with 160 shares, which would still be equal to 20% or 25% of the company. That percentage will not change. So this is one of the advantages. Okay? This is here where we're looking at, for example, this is Medland Corporation, assuming it splits the 50,000 shares of common stock on 2-to-1 basis. So every stock becomes 2. Every share becomes 2. Okay? So the number of outstanding shares went from 50 to 100. Again, stockholders' equity is not affected. Why? The company is not issuing new stocks. They are splitting the stock. So it's not like they are adding, just simply adding. They are not changing the percentage of ownership. Nothing is happening as far as this is concerned. They are splitting the stock. So stockholders' equity does not change. Retained earnings and paid-in capital does not change. The only things that actually change are outstanding shares and par value per share. And as you can see, if you multiply both of them, you still have the same amount. So it used to have 50,000 multiplied by $10. Now you have 100,000 multiplied by $5. Do you have any question about that? So don't get mixed up when you have stock splits and when you have stock dividends. And remember, stock splits, you do not need to make any journal entries for that. We get to retained earnings. This is the part, as we talked over and over, this is the part of net income that the company keeps in the business to run their operations, to expand, to basically meet their obligations, etc. So this is the money that the company decides to keep in the business. Okay? And as you can remember, net income increases retained earnings, net loss decreases retained earnings. We usually close net income or net loss at the end of the year to retained earnings using the account income summary. Okay? Okay, so if retained earnings for a certain reason, retained earnings, if the ending balance in retained earnings is the debit balance, that means the company is in deficit. Okay? On the balance sheet, we said we have two parts, paid-in capital and retained earnings. Any questions so far? Okay. Now, with the retained earnings, there are sometimes certain restrictions. If the company, if you remember, we talked about that, I think with bonds, etc. Sometimes when the company wants to issue bonds, they might ask them to have some kind of restrictions. Those restrictions are the amount that would be, like for example, the company is not allowed to use them except for that specific intended use. Pension funds sometimes, they have this, okay? So it could be for legal restrictions, could be for contractual restrictions. Contractual restriction is like I said, for example, if you want to get a loan from a bank, they might ask you to have a certain amount restricted for that loan. Why? They want to make sure that you will be able to pay, not all the debt, however, at least you will be able to pay for the foreseeable future interest amounts as well as part of the principal. Sometimes there are voluntary restrictions when the board of directors decide to keep, they put some kind of restrictions so that the company does not use them as dividend or pay that amount as dividend. They want to make sure that this money will stay in the business for next year, especially if they are going to do, for example, they are going to build a new manufacturing plant. If they are going to acquire a new asset where they will need this retained earnings to do that. Okay? Restrictions are usually reported in the notes of the financial statements. Okay? It will explain the amount, and it will also explain the reason why this is restricted. So for example here, certain of the company's debt agreements, okay, they require compliance with debt covenants. As a result, the company has restricted, they have unrestricted retained earnings of $223.8 million unrestricted. The remaining ones are restricted because of the bonds that because of the debt agreement with the bank, for example. Okay? Now, in certain cases, there are errors or mistakes that happen. Let's say, for example, when you are actually, you remember we talked about inventory errors, right? So what happens when there's an error in counting inventory at the end? If you remember, we would have also the error would be carried on to next year in the form of basically because ending inventory will also affect what? Beginning inventory, but also cost of goods sold, right? Remember, cost of goods sold is equal to total, basically this is cost of goods available for sale minus ending inventory. So you know the numbers of cost of goods available for sale. You made a mistake in counting ending inventory. This mistake will also show up in the cost of goods sold, right? Cost of goods sold is an expense, which is to mean it will also affect net income. Now, at the end of the year, you are going to close net income to retained earnings. Okay? So what the company does, this is if there's any problem if there's a problem like that, the company cannot adjust this year's, the company will not be able to adjust. For example, if the error happened in 2014, the company will not adjust net income for 2015 because net income in 2015 has nothing to do with net income in 2014. Remember that. Those are temporary accounts, right? So it has nothing to do with 2014. This error will be carried over in the second year in retained earnings. So the correction will have to happen at the level of retained earnings. Okay? It could be just a mathematical mistake. You miscalculated something. You will get fired most likely, but this is what happens. You made a mistake. It could be just, if you remember with inventory, for example, in transit, something goods in transit, stuff like that. If you miscalculated something like that, then you might have certain issues. So this is how you do. What you do is you make the correction at the beginning of the year, for the beginning of the year. So you will have retained earnings. Let's do this example, it will explain it better. Assume that General Microwave discovers in 2014 that it understated depreciation expense on equipment. So you see, could be, for example, if you understated a certain expense, you would have overstated net income, right? So when you close that amount to retained earnings, now retained earnings is overstated. This is what you need to correct. So it understated depreciation expense on equipment in 2013 by $300,000 due to computational errors. These errors overstated both net income for 2013 and the current balance in retained earnings. Again, because you closed in net income, the overstated net income to retained earnings, which led to overstated retained earnings. The entry for the prior period adjustments, ignoring all tax effects. In this case, we're not going to talk about the tax effects. We're simply going to do retained earnings, okay? So what do you need to do? You have retained earnings is overstated. So you need to decrease it. How do you decrease retained earnings? By debiting retained earnings 300,000. Okay? You credit accumulated depreciation for equipment. This is the account that had an issue. And this is, remember, it's an account that is carried over. This is not a temporary account. It was not closed. So what you do is you actually credit accumulated depreciation. We do not make any changes to depreciation expense because depreciation expense was an expense that was close to income summary, which was in turn close to retained earnings. So this change here in retained earnings, this, when we are actually fixing retained earnings, it will automatically fix the mistake that is associated with the depreciation expense. Okay, so we credit accumulated depreciation from equipment 300,000. And here, basically for the explanation, you say this is to adjust for understatement in the previous year, in the prior period. Okay? So here, this is the same example. You start with, for example, balance. So this is retained earnings. Retained earnings, January as reported. As reported, it means this is the one that has a mistake. This is the one that was reported last year. And then you have the adjustment. Correction for overstatement of net income in prior period due to depreciation error. You are decreasing retained earnings by 300,000. Now you say a second one will be balance on January 1st as adjusted. This is the one that now you will start adding net income from the new year. So this is like in 2014, right? In 2014, this is the new balance that you will start with. We used to, for retained earnings statement, we used to do what? Retained earnings beginning balance, add net income, less dividends, and that will give us retained earnings balance at the end of the year, right? Here, we need to make this additional step to correct the previous number. So it was the reported number had a mistake, so you need to make the adjust to bring in the adjusted number. Okay. So the statement of retained earnings for the year ended December 31st, 2015 would be balance January 1st. This is 1,050,000. Add net income less dividends. The new balance is 1,110,000. Okay? Let's say that before issuing the report at the end of the year, before actually filing those financial statements, the company discovers a 50,000 error net of tax. Again, ignore the tax. That caused 2014 inventory to be overstated. What ending inventory is overstated, cost of goods sold would be understated. So net income would have been overstated. Okay? So net income was overstated. Would this discovery have any impact on the reporting of the statements of retained earnings for 2015? Yes or no? So net income from the previous year was overstated. Will that affect the balance in 2015? The balance and retained earnings? Yes, it will. Remember, the net income from previous year is close to retained earnings of this year. So the mistake is carried over not in the form of net income, but in the form of retained earnings. And when I say in the form of retained earnings, why? Because this overstatement of net income led to an overstatement of retained earnings, of the beginning balance in retained earnings. So this one is actually overstated. Okay? Net income from 2014 2014 was overstated. It was closed to retained earnings beginning of 2015, which is mean it's at the end of 2014, so it's carried over to the beginning of 2015. So the beginning balance of retained earnings is overstated by 50,000. You need to adjust that before you actually file the financial statement. Okay? So what happens? You start with this balance, January 1st, as reported. This is the one that has a mistake. Here we have an error. What's the adjustment? It's overstated by 50,000. So what do you need to do? To decrease it by 50,000. Remember, this is the statement itself, so there is no debit and credit. Here we're not doing. Yes, you do that. So the journal entry would be to debit retained earnings. Before we do that, here we're looking at the financial statement itself. So what do you need to do? You have less. So this is a prior year adjustment. You subtract 50,000. The new adjusted balance, it will be like balance on January 1st as adjusted. This is the adjusted number. This is the correct one, as restated or adjusted. So this is the correct one. Now, what do? You add net income for this year, subtract dividends, and then you end up with the new balance, which will be in this case correct. Any questions? Okay. Now, if you remember, what are the entries or the accounts or the changes that, or the events that will affect retained earnings? Net income. Net income will increase. This is like a T account, so this is the T account. What happens? Retained earnings has a normal credit balance, right? As a result, the ones on the right side will increase retained earnings. So net income will increase retained earnings. You have prior year adjustment for understated net income. You need to add it. You need to increase net. In this case, you need to add it. So you have understated retained earnings. To adjust for it, you have to increase it. Okay? On the other hand, when you have a net loss, it will decrease retained earnings. When you have prior period adjustment for overstated net income, it will also, and it will result in a decrease in retained earnings. The adjustment will have to decrease retained earnings because you had an overstated net income, which is meaning you have an overstated balance in retained earnings. You have to decrease it. And if the company gives, when the company gives cash dividends and stock dividends, remember, this is the part of retained earnings that the company is giving back to their shareholders. It will automatically decrease retained earnings. The last one is some disposals of treasury stock. Remember when we said that if you don't have enough balance under paid-in capital, in the account paid-in capital from treasury stock, when we did not have more than, when we did not have the whole difference, we had to take money from retained earnings. Do you guys remember that? This one here. Do you remember it? When we sold treasury stock below cost, and we did not have enough balance, enough paid-in capital from treasury stock to cover the difference between the selling price and the cost of acquiring those treasury stocks, we had to debit retained earnings. This is what we mean here. This is what we mean here by the changes to retained earnings. Any questions? This is basically here from selling treasury stock below cost. And it's not always, it's only when you don't have enough balance and paid-in capital. Any questions? Okay. So the financial statement in this case, the retained earnings statement will look like this. After you make this adjustment, you have balance as reported. This is the one that has the error. Then you have the adjustment, correction. For understatement, it's 50,000. This is subtracted. Okay. Oh, this is for understatement. Sorry. Okay. So here, if you had this in this example here, we had an overstatement. In this example here, it looks like, for example, you had an understatement in net income. So you have to add this error. You have to fix this error by adding that amount to the beginning balance. So you have later on you would have again balance as adjusted or as restated. You add net income, subtract dividends, and then you get to the ending balance and retained earnings. If you had net loss, it would be less net loss, less dividends, and then you're done. Then they will give you the whole the ending balance of retained earnings. Now this is sample of the stockholders' equity section of the balance sheet. You have paid-in capital and you have retained earnings. At the end, you have less treasury stocks. So under paid-in capital, you have for capital stock. Capital stock is common stock, it's preferred stock, and common stock dividends distributable. Some companies, they just gather all the paid-in capital in excess and then they put it all under additional paid-in capital. This is the part here. So this is capital stock. When you hear capital stock, it's preferred stock or common stock dividends distributable. And like you see here, as you can see, companies would actually declare or disclose information such as 9% preferred stock. What does it mean? That the company, it is cumulative here, so the company will have to pay dividends every year, or at least, let me put it differently. Stockholders, the preferred stockholders, have the right to 9% of the $100 par value, which is to mean $9 per preferred stock. So it's $9 every year. And this is a cumulative, which is to mean if the company does not declare dividends this year, they don't lose that right. It will be simply carried over to the next time until the company declares and pays dividends. Then they take all the dividends in a year. You have how many shares that are authorized, and you have the ones that are issued and outstanding. So this is authorized, this is issued and outstanding. You have the same information, information for common stock, etc. Okay? This one has no par value. It has $5 stated value. So the company will disclose all this information. When you look at it as an investor or creditor, you know immediately how many stocks a company can still issue. So the company has 500,000 shares authorized, 400,000 that are issued. That means that the company can still issue 100,000 shares. Okay? The company has 390 shares outstanding. That means the company has 10,000 shares as treasury stock. This is the amount here that you can see here. Now retained earnings, they have some restrictions. You can see the note. In this case here it says note. Here what it shows is note R for restrictions. Retained earnings is restricted for the cost of treasury stock of 80,000. So the company cannot use 80,000 because those are restricted for the cost of treasury stocks. Any questions? Okay. Once again, companies, investors, etc., they are interested in knowing, for example, how much their investment would give them. Okay, so they are interested in return on common stockholders' equity. So you have to think about it in a way similar to when we did the common stock dividends, the dividends for the common stock shareholders. First, if the company has preferred stock and common stock, you need to remove the part that is for preferred stock. So you remove preferred stock equity you subtract that from total stockholders' equity, it will give you stockholders' equity for common stock. Okay? You divide net income minus preferred dividends, because preferred dividends will have to go to preferred stockholders. So net income minus preferred dividends, you divide it by the average common stock equity. This will give you the return on common stock equity. Basically, it tells you how profitable is your investment. Okay? It shows you how many dollars of net income they earn for every dollar of investment in stockholders, and common stock, basically by common stock shareholders. Okay, so for example, to illustrate Walt Disney Company, beginning of the year and end of the year, common stockholders' equity were $31,820 and $30,753 million, respectively. Its net income was $4,687 million, and no preferred stock was outstanding. So this is why here, the zero here, it comes from no preferred stock. You just divide net income minus preferred stock by the average common stock equity. This one is book value per share. This is another ratio that is important. Companies, investors, they want to know, and creditors, etc., basically interested users of financial information, they want to know what's the value, according to the company's books, what's the value per share, usually, and here we're talking about the common stock. What's the value of that company? What's the book value per share? So what you do, you divide stockholders' equity by the number of common shares. Okay? So, in order to do that, first you need to remove, again, preferred stockholders' equity. You subtract preferred stockholders' equity from total stockholders' equity. That will give you what? Total equity of common stockholders. This is the amount that you will be dividing by the outstanding by the number of outstanding common stock. So using the stockholders' equity section of Graeber Inc. shown in the previous illustration, in the previous example, Graeber's preferred stock is callable at $120 per share. Since it means this is the amount that the company, if the company wants to buy back preferred stock, they will have to pay $120 per share. It is cumulative, just to mean before you actually calculate common stockholders' equity, you have to subtract their preferred dividends. Assume that dividends on Graeber's preferred stock were in arrears for 1 year, $54,000. The computation of preferred stockholders' equity will be, this is the first step. It's stocks, the outstanding stocks, which are 6,000, multiplied by the callable price. This is the value of those stocks if the company were to buy them back. You add to that the dividends that are in arrears. So this is the value of stockholders' equity, or preferred stockholders' equity. We need to subtract that from the total stockholders' equity. Remember, to calculate stockholders' equity, how do you do that? You have total assets minus total liabilities, okay? it gives you total stockholders' equity. So in this case, total stockholders' equity is 4,810,000. Subtract 774,000 from it. It will give you the common stockholders' equity. So common stock equity. Common stock equity is then divided by the outstanding common stocks. Okay? That will give you the book value per share. Remember, in order to do that, first you need to calculate preferred stock equity. Subtract that from total stockholders equity. It will give you common stock equity. You divide common stock equity by the shares of common stock that are outstanding. It will give you the book value per share. Okay? And this, by the way, book value per share has nothing to do with the market value per share. Market value per share is again, market value, it depends on the supply and demand, it depends on the sellers and buyers. Book value, it is based on the cost. Okay? So it's based on whatever the company paid or issued those stocks for. And there is basically the relationship between the two is not that, in a way, it's not that, I would say, significant in that, for example, it doesn't have to even fall in the same range. So at the end, for example, for this company, book value per share was 13.38. However, the market range, the price that it was traded for was between 31 and $22.89. Which means it's not even in that range. Because you're using two different variables to actually measure those amounts. The book value is based on the costs. It's based on the company's own records. Market value is based on how much it was traded in the stock market. Okay? Any questions? Here you are asked to calculate basically the cumulative, the preferred stock dividend. 0? Seriously? This is the grade that you will get on that question. It's actually 480,000. Think about it this way. So you have on January 2nd, 2008. So 2008, the company issued 20,000 shares of 6% cumulative preferred stock at 100 par value, which is to mean the company will be paying every year. So every year is going to be 6% multiplied by 100 par value multiplied by 20,000 shares. That's how much? Every year, 120,000. Then you have, on December 31st, 2011, the company declares and pays that amount. How many years in arrears does the company have? 2008, 9, and 10. 3 years in arrears plus the current year. So it is, for 4 years in total, you have 2008 through 2011. This is 4 years. So it's going to be 4 multiplied by 120,000. Okay? Just think about it, how much the company will have to pay those shareholders. Okay. It's like almost a perfect step. Like it's a stair. So I'm going to give you a smiley face just for that step. Okay? Now the correct answer is A. When you write the journal entry, you're looking at what? So here you have, the company is selling 200 shares of treasury stock for $40. This is the amount of cash that the company will receive. The company will debit cash 80, right? 8,000. This is based on market selling price, right? And then the company will credit treasury stock how much? How much? 8,000? 6,000. Why? Because this is based on cost. It costs when they purchase them, they acquire them for $30. The third part would be a gain, right? No, it's going to be paid in capital from treasury stock, 2,000. A credit to 2,000. When you look at that, you can see that it is only the first, right, the first answer that fits in. That's the last one.
Oh, okay. Oh, this one?
And then we can start chapter 12.
Yes.
Okay. Again, what you do here, book value per share. You divide. You divide what? What do you need to divide? The company does not have any preferred stocks. Right? So you divide stockholders' equity by the number of outstanding shares. 1,000, you made 1 million. So this is what you do. 7,700,000, and you divide that amount by 1 million. Okay? Any questions?
No questions.
No questions. Okay, I'm not going to start the new chapter now. Go ahead. Happy Thanksgiving, everyone, and see you next Wednesday.